In the first quarter of Narsharluk, Japan's corporate capital expenditure grew by lean C% year-on-year. That's not a rounding error, that's essentially zero. And for context, the forecast was C%. The actual number missed by nearly the entire length of the fall.
Japan's economy grew 1.8% annualized in the same quarter. Corporate profits rose 6.6%, and yet Japan Inc. chose to invest almost nothing new.
This requires an explanation, because it contradicts a decade of very expensive effort to change precisely this behavior. 10 years ago, Japan's corporations were sitting on what analysts called the largest corporate savings account in the developed world, over $1 trillion in idle cash, not invested, not returned to shareholders, just parked. The causes ran deep: the trauma of the 1990s crash, decades of deflation that made holding cash the rational choice, and a management culture that prized stability over returns.
Japan's government spent a decade trying to fix this. The Corporate Governance Code of Nessun pressured boards to improve shareholder returns. The Nessun revision went further, requiring outside directors and explicit plans for capital allocation. Then, in Nessun the Tokyo Stock Exchange did something unprecedented. It publicly named every listed company trading below book value, roughly half the Tokyo market, and demanded they explain what they plan to do about it. The message was unusually direct for Japan. Deploy the cash, or justify why you're holding it.
It worked. For a while, between NAR-NARS and NAR-TAR-4, share buybacks in Japan rose for 5 consecutive years. In fiscal NAR-NARS fall, listed Japanese companies authorized trillion roughly $2 billion in buybacks between April and December alone. Total shareholder returns including dividends topped Sanju NAR-TAR for the year. The average price-to-book ratio on the TC prime market climbed from E10 each in NAR-NAR-NAR to E10 sen by NAR-NARS 410. Return on equity improved from H10% to K%. Foreign investors poured in. Nikkei hit record highs.
The narrative wrote itself. Japan had finally done it. The corporate governance revolution had arrived. The long-hoarded cash was moving.
Then came fiscal year and the narrative broke. In the fiscal year ended March Sandy year, Japanese companies announced Sen-Sanchur-lo 4 buyback programs, down from Sen-Sanchur-yu to the prior year. The first decline since Nisern. Meanwhile, capital expenditure surveys showed spending by manufacturers fell 2% year-on-year, led by information technology and automotive companies scaling back after years of expansion. The aggregate capex number for Q1 Nisern up 9%, for all practical purposes flat.
3 things happened simultaneously to reverse the momentum. First, American tariff policy. The threat of % tariffs on Japanese automobiles, which was real, not theoretical, directly hit the companies with the largest capex budgets. Toyota, Honda, and Nissan are not abstract actors. They are Japan's biggest corporate investors. When the rules of trade shift unpredictably, the rational response is to wait. And in Japan's corporate culture, where the ringi system of consensus decision-making requires buy-in from multiple departments before any major commitment, waiting is the default when the environment is unclear.
Second, the Bank of Japan. In Nissan-Nisif, the BOJ raised rates for the first time in 17 years, ending a generation of zero-cost borrowing. By Nissan-Ni-look, the policy rate stood at 10%. That sounds trivially small. But for a corporate sector that built its entire capital allocation logic around the assumption that money was free, even a modest rate means that sitting on cash now has an opportunity cost, and deploying it carries a real borrowing cost for the first time in memory.
The result was not more investment, it was paralysis. Companies that had grown comfortable with ultra-low rates did not suddenly become bold risk-takers when rates rose. They froze.
Third, geopolitics.
The Middle East conflict drove energy costs higher and disrupted supply chains that Japan's manufacturers depend on. The Bank of Japan held its rates steady at the April Thainilok meeting specifically because of Iran-related uncertainty. If the central bank itself was waiting, companies had every excuse to do the same.
Together, these three forces delivered a stress test to Japan's governance reform, and the results are uncomfortable to read.
Here is what they reveal. Japan's corporate governance reforms changed the outputs without changing the inputs. When the external environment was favorable, low rates, stable trade, rising markets, Japanese companies responded to governance pressure by returning cash to shareholders. They did what the codes required. But the underlying decision-making culture, the risk aversion that accumulates over 30 years of deflation and 2 decades of stagnant growth remained intact. When conditions deteriorated, companies did not say, "We've reformed, we have new governance frameworks, we will invest through the uncertainty." They said, "Wait."
This matters because it distinguishes between two different theories of change. One theory is that better governance codes produce better allocation decisions over time, regardless of conditions. The other theory is that governance codes change behavior only when conditions independently favor action, and the moment conditions turn adverse, the old instincts re-emerge.
Japan's Nuhan Nohashiv data suggests the second theory is closer to the truth, and that has significant implications for what comes next.
Japan's government is not standing still. Prime Minister Sanae Takaichi's administration approved Juhai Ruthli Fiekchu Godol billion in new economic stimulus, with tax credits of 4% for R&D in AI, semiconductors, quantum, and advanced robotics. The Nasen Nestraluk budget allocated 10 trillion specifically for AI and semiconductor investment, nearly 3 times the prior year. The intent is to make domestic investments so tax-advantaged that even cautious Japanese companies find it rational to act.
This approach has a logic to it. If behavioral change has its limits, maybe financial incentives can accomplish what governance pressure alone cannot. Make investment the highest after-tax return option, and you remove the need to change the culture.
But the fiscal cost is real. Japan is already running a debt-to-GDP ratio above 60%. Subsidizing corporate investment at this scale is a policy that works only if the investments it produces generate enough growth to justify the cost. That is not guaranteed.
The deeper question is one of time. Japan's corporate leadership is still predominantly shaped by the generation that lived through the 1990s crash. The generation for whom cash hoarding was survival strategy, not failure. The executives now making capex decisions spent their formative careers in companies that collapsed when they overextended. Their caution is not irrational, it is the logical output of their experience.
The governance revolution changed the rules, it did not change the people, and changing the people takes time that policy cannot accelerate.
If you want to keep up with stories like this, subscribe to the Japan Factor. Japan's next decade will be determined in large part by whether the generation of managers who grew up after the lost decades, the ones who know deflation only as history, not as lived experience, can take the controls. They will face the same governance codes, the same external pressures, but they will not carry the same memory of what happens when Japan's companies bet wrong and lose everything.
The question worth watching is Japan's capex problem a temporary response to temporary headwinds, or the first evidence that the governance revolution was always shallower than it appeared?